Let's just get right into it, because the Forex market is entering a truly critical moment right now. Honestly, if you're watching the charts at all, you can literally feel the tension building. Today in this explainer, we are looking at three massive stories that are completely dominating trader conversations and, frankly, reshaping the entire landscape. We're talking about the Federal Reserve's impending next move, the future of oil prices on the heels of recent geopolitical tensions, and this escalating prop firm controversy that's raising some very serious questions about trust in the industry. Now, you might be thinking, well, any of these stories on their own is enough to move market sentiment, right? And you'd be absolutely right. But all three together, they are converging to create what is probably the most uncertain market environment we've seen in recent memory. We have these massive macroeconomic shifts colliding head-on with industry-level disruptions, and it's basically forcing everyone to completely rethink their positioning for the week ahead. Okay, let's dive into this. To break it all down, we're going to use a sort of macro to micro funnel, tracking four main things today. First, the Fed rate debate. Second, oil's chain reaction. Third, the prop firm controversy. And finally, specific currency pairs to watch.
Starting us off at number 1, the Fed rate debate.
Now, what's really interesting about this slide is the sheer contrast. For months, traders were banking on this really clear, straightforward narrative. Inflation was cooling, which theoretically gave the Fed plenty of room to ease up on monetary policy and finally deliver those impending rate cuts. But, well, reality just threw a massive curveball. Actually, scratch that. It's more like a brick wall. We're dealing with sticky inflation that simply refuses to drop, surprisingly strong economic activity, and rising energy prices. And this data has just completely complicated the picture. The result? The US dollar has regained serious strength as traders scramble to adjust. Major currency pairs like EUR USD and GBP USD are feeling incredibly heavy pressure right now as the markets compare the US monetary policy stance with other central banks around the world. So this brings us to a really pivotal issue. It isn't just a simple, will the Fed cut rates anymore? The much bigger question is, how quickly can the Fed cut without reigniting inflation concerns? It's literally a tightrope walk. One wrong signal from the Federal Reserve, like just one tiny hint that they are moving too soon or holding off too long, could trigger massive volatility across all currency markets. Everyone is just waiting for that trigger. Which leads us perfectly into Section 2, oil's chain reaction. And this brilliantly illustrates exactly why energy markets matter so much right now. To understand inflation right now, we really have to look at how a single barrel of crude oil can dictate a central bank interest rate decision. Let's walk through the domino effect here. Step 1. Oil prices rise because of geopolitical tensions and supply concerns. That immediate spike leads directly to Step 2. Transportation and production costs shoot up for businesses everywhere. Everything gets more expensive to make and to move. When that happens, we hit Step 3. Inflation pressures return really quickly to the everyday consumer level. And that puts central banks in a terrible position, leading to Step 4. Central bank rate cuts are delayed. A weaker inflation trend gives them the green light to cut, but this rising oil dynamic, it completely slams the brakes on those decisions. It's a direct chain reaction. So what does this all mean for us as Forex traders? Higher oil equals a stronger US dollar? It's a fascinating dual impact, really. On one hand, higher oil prices absolutely support currencies that are tied to energy exports. But on the other hand, they can drive incredible strength into the US dollar. Why? Because if traders expect inflation to stick around due to high oil, they also expect higher interest rates in the US for a much longer period of time. This is exactly why you cannot ignore energy markets. A move in crude can almost instantly become a major move in currencies. All right, let's shift gears entirely for Section 3, the prop firm controversy. So stepping away from the macroeconomics for a second, let's talk about the industry itself. For years, funded trading firms or prop firms have been incredibly popular. They offer traders access to huge account sizes without requiring them to risk their own personal capital. Sounds great, right? But recent controversies have sparked some really serious debate around trader protection and systemic risk. The community is actively demanding answers to three major questions right now. First, just how sustainable are these business models in the long run? Second, exactly how transparent are the trading rules before a trader even signs up? And third, what happens when thousands of retail traders depend entirely on just one platform? If a firm changes its rules or faces regulatory heat, the fallout for the retail community is, well, it's massive. So the crucial point is this. In trading, reputation is literally everything. The future of the prop firm industry ultimately depends on trust. A broker, an exchange, or a prop firm can have the absolute best, fastest, most cutting-edge technology in the entire world, but without foundational trader confidence, growth is nearly impossible. Traders absolutely need to know their capital and their time are protected. Let's move to and see how this builds into our final segment, Section 4, Currency Pairs to Watch. Okay, funneling all these macro and industry themes down to actionable setups right on your screen, here is your cheat sheet for the upcoming sessions. First up, Euro USD. The primary catalyst here is this ongoing tug of war between Fed and European Central Bank expectations. Any shift in who blinks and cuts rates first is going to heavily drive this pair. Second, USD JPY. The Japanese yen continues to be highly reactive to interest rate differences and any shifting central bank decisions. And third, gold. Gold is absolutely fascinating right now because it's caught in a vice between two incredibly powerful forces. You have safe haven demand pushing the price up, actively fighting against the heavy pressure of higher interest rates pushing it down. The next few sessions could absolutely determine whether these established trends continue or sharply reverse. The Forex market is not waiting for next month to make its move. The biggest shifts in trader positioning are happening right now. Fed expectations, oil volatility, and major industry changes are reshaping the board as we speak. So I want to leave you with a question to bridge the gap between just passively learning and active market analysis. Which market factor are you watching most right now? The Fed, oil, or currency volatility? More importantly, if one of these pillars snaps tomorrow, is your portfolio positioned to survive the fallout or profit from it? Think about that, and I'll see you next time.